Welcome to the Financial Technology Report, a leading information source on financial technology companies and solutions. In this episode, we speak with Ryan Stroker, founder and CEO of Avenue One, a technology platform that connects institutional debt and equity capital with local real estate operators investing in single-family rental housing. Avenue One uses data, analytics, and underwriting technology to support acquisitions, financing, renovations, and asset management, enabling institutions to deploy capital more efficiently while giving local builders and property owners access to scalable funding. The platform operates across more than 20 U.S. markets and supports investments in residential rental portfolios at scale. Before founding Avenue One, Ryan spent years in capital markets and residential real estate investing, including senior roles at Amherst, Royal Bank of Scotland, Merrill Lynch, Credit Suisse, and Goldman Sachs. I'm your host, RJ Lumba. We hope you enjoy the show. If you like the episode, click the follow. Ryan, thanks so much for joining. Appreciate it.
Happy to be here.
So where I thought we could start with Avenue One is the early days and how you thought of the idea. You had been working more so on the investing side, I believe, and you got your early start to your career more with financial institutions. So we'd love to hear a little bit about the origin story of Avenue One.
Sure. I came up through the asset-backed world. So banking, trading, structuring, and I was a glory days subprime bond trader for Merrill. Actually 2005 to 8, like right through the crazy times. And that's how I kind of got my feet wet to understand the products, but it really just got a good sense for not only how the markets work, but also how these products are actually created. So investments backed by specific collateral and then pricing the cash flow. And as my career progressed, really at the end of the day, Wall Street is connecting people who need money and people who have money, and really identifying the gaps. And the company that I was working with was really a boutique investment bank that was focused on the really housing asset class, and the established and predominant investment in that capital markets asset class is like the mortgage-backed security. And so really, I spent a number of years really connecting institutional investors who wanted to invest in this space into the opportunities that matched their risk constraints and their capital. That was my background. And what I started to identify was how much demand there was for assets and alternative assets just in general, which is kind of the world that I have been playing in. And secondly, how complex and fragmented the connectivity into effectively like deploying that capital. There's something like 13 to 15 trillion dollars of mortgage-backed securities that exist in the capital markets. And, those are made up of, millions of $200,000, $300,000, $400,000 loans. And just getting a sense for that and appreciating how big it is and how complex the kind of established infrastructure was to enable it. So that's kind of my background.
It's super helpful. And then when you started to hone in on a tech company or a platform that could help enable connecting capital or investors to real estate entrepreneurs, did you think first to head into like the builders, like those that are seeking to build new housing in various parts of the country? Was that the kind of initial angle?
The initial angle before even choosing kind of who the money is best deployed to, traditionally, if people were trying to solve this problem, what ended up happening and has continued to happen is people stand up funds or people back folks that are originating deals into the local community. So that can be a hard money lender. That could be, a local lender for just a mortgage, was also to a large degree banks as well. And so knowing that the traditional way to do this has been in the form of funds. And so you've got hundreds of these funds, whether it's, a wealthy individual or it's a larger regional or institutional investor, all trying to do the same thing. And what I identified was that there is no infrastructure. Like everyone's trying to do the same thing. Post-crisis, one of the newer, unique ways to identify or to kind of deploy capital was into single-family rental. Mm-hmm. And that was, in my mind, the equity side of the same widget that the capital markets have really accepted and embraced. But there was no accepted and embraced way for institutional investors to participate in the equity of this home. That's where the Avenue One idea started, was that I could either go create a fund and kind of extract an opportunity, or I could think about it differently. And that's where this asset light approach kind of clicked in for me, because it's more about connecting than it is extracting. And so to me, that was the big opportunity. It wasn't creating this fund and trying to grow it. It was identifying the general need for capital to find its way into these local communities. That's where Avenue One kind of took its shape.
Mm-hmm. I don't know if you kind of frame out your company as a marketplace, but they can be complicated to build. I mean, you kind of have to have two sides, scaling up in parallel. What did you see as your key action item or priority as you were getting this company off the ground?
First, it was identifying what was the driver, what side of the market could you and should you start with? And because of my background and my connectivity, I had a lot of great confidence in my ability to deliver what's needed for institutional investors to get comfortable with putting capital to work. Knowing what they need and then actually creating it are two separate things. So that's really where it started. It was, okay, I'm starting with capital, and now I have to figure out a way to take a large investment, break it up into much smaller logistics that still gives and offers the governance that institutional investors need, but do it in a very small way, almost like a manufacturing line. So I started with my confidence and knowing that there's capital, knowing what that capital needs in order to write checks, and then really plugging into the supply. And at the time, the supply was enormous, right? It's homes across the entire US. But you had to kind of figure out a way to do it in a way that was repeatable and scalable.
Mm-hmm. And so to get a little bit into the assets themselves, are they primarily single family rental? Are they multifamily? Like, what's the portfolio of assets look like?
Yeah, so we were focused specifically on single family rentals. And traditionally, and the reason is because there is very limited institutional touch points and presence in this space. There was very limited, if any, real professionalization of this as an asset class. There are something around 12 to 15 million single family rental properties in the US. And something like around 3% of those 15 million properties are owned by big investors. It's a drop in the bucket. And so the opportunity was, and the focus was, how do we accomplish that connectivity? So the fast forward of kind of phase one of Avenue One was we ended up sourcing $2.5 billion of individual homes. And we sourced them one by one. And we also determined the ownership of every home in the US and effectively identified these local investors who would own a portfolio of these rental homes. And we went out to them and started to prove that we're a trusted partner in, providing liquidity for what these local investors had built. So we acquired a little over 10,000 properties, renovating every single home with an average renovation price of about $40,000, and having to kind of deploy all of that capital logistically to stay under budget, which is what we did on our scope, which was one of incredible feat, was really what was needed to deliver this capital into the market on behalf of institutional players. So that's what the average size home is. Probably it was $200 and maybe $30,000. That same home today is probably 325, 350. Just in general across the US. But that's the profile of these homes.
I see. And are there certain geographies where there's, higher concentration?
Yes. What you tend to find is that rents are inelastic. So a home that costs $300,000 to buy will rent for around $2,000 a month. But a home that costs $600,000 to buy doesn't rent for $4,000 per se. And so really what you're doing is you're finding the regions and the areas of the country where home pricing is lower and there is real density of people. So that ends up being, like we're in 22 cities. It's kind of like the Sun Belt a little bit, like a smile states kind of. That's traditionally where most institutional investors have focused, because to date, a majority of that capital has been yield and cash flow investors. So really betting on the difference between the cost of the home and the rent you can get for that home versus an expectation of home prices to improve, and then you'd have a total return.
Can you give us a sense for the scale of Avenue One today?
I'd say in 23, when rates moved, the demand for deploying capital into buying real estate really slowed. Because next thing you knew is you could buy a 70 LTV mortgage and get paid the same rate as what you could if you bought the home itself. And so that is when our kind of phase two became relevant. And that's where the home builder piece really came into play. So at the end of the day, our thesis is really enabling these local professionals, whether they're investors or they're home builders, just giving them connectivity to the capital markets. And we have operations and we own homes across the country. And so what's the value by us having bought and now manage over $2.5 billion of homes? What is the value or the unique ability that we offer that others might not, that would enable us to be differentiated in the credit space? And so first thing that we really started doing was we realized that as we tried to buy more homes from these local investors, they didn't want to sell to our bid. Yields had backed up, our prices were lower. But the folks that really did need to move product or sell their homes were home builders. So we started buying, I think we bought $200 million from builders, and not from the largest builder in the country, but the folks that were like one step below, that didn't have connectivity to the capital markets. And that evolved from a kind of our unique relationship with these builders. And the builders started asking us, hey, could you also help us out with financing? And before we did that, we took a real hard dive into understanding the market, really understanding what data was out there, and really tried to understand what we were potentially getting into. And fast forward 9 months of really finding the limited amounts of data in this space, we ended up mapping 75,000 builders, what we call is like our builder database. And it has 75,000 builders in the country, along with kind of their past production, their current pipeline of horizontal development, vertical development, finished unsold product, and effectively extrapolated their balance sheet. So we have this kind of unique tool that we've been using to, one, connect to builders, but then give institutional investors kind of a relative understanding of how builders kind of compare against each other. And I appreciate how big the gap was. There's a housing shortage, and builders are operators. They're not capital markets pros. And so giving them a one-stop solution for equity or financing access to capital was something that was really unique. And so that's kind of where we find ourselves today, is really focused on the biggest need of the day and kind of where the capital markets are most interested, comfortable, and on board to go deploy their capital into ways to enable these home builders.
I see. And is it still mostly single family that these home builders are building?
Yep, it's all single family. So we stick with what we know, and it's just so big and differentiated that we don't really need to expand products.
Right.
So there's an insatiable appetite for capital from the capital markets, because what currently exists today, these builders are dealing with a patchwork of local lenders, local banks who have continued to kind of pull out of this world for a number of reasons. And we're all up against this housing shortage of millions of homes. So we are partnering with, some of the world's largest investors to go create and standardize a widget, a product, a financial tool that can be offered to these builders. And they know that there's consistency in what it is that we're creating. That's step one. Step two is really to deliver this capital directly into the capital markets. So it starts with a loan, becomes a pool, same thing with kind of asset-backed finance. We securitize the pool and kind of create a palatable investment for the capital markets, which then flows through into these builders. And that's kind of what we're working toward.
Got it. Okay. My initial kind of statement about it being a marketplace, it's not really a marketplace because on the investor side, you already have that. You don't need to build up like multiple participants.
Yeah. On the equity side, there are not many participants. On the credit side, there are plenty of participants. So a lot of what we do, like one of the unique pieces of what we offer on these loans, is we stay on these loans to oversee and govern the risk on behalf of those investors, which doesn't really exist. And so in having, renovated 10,000 homes across the US and having local connectivity and operations gives those investors a unique and differentiated third-party partner. There's a lot of investors who want to get into the space of home building, but really don't yet have that comfort. And so that's where our role in these investments play a big part. Very simply, it's like, just to start, it's a construction loan. However, the way that we are delivering it is not a bespoke one-off decision. It's more like how Fannie and Freddie offered a framework for institutional investors to participate. It's the same concept. So creating that standardized framework is the thing that will help investors to know what they're getting and have comfort to participate.
And what do the returns look like for the investors?
So generally speaking, the market for construction loans are somewhere between, call it 8 and 10% unlevered. And they are, call it somewhere between 70 to 85 LTV. And these are traditionally 12 to 24 month loans.
Got it. Switching gears a little bit more about your background that we touched on in the beginning, you had an interesting, I guess, stint as a founder or co-founder of My Blue Blockers. I thought that was super interesting. Everyone remembers those iconic sunglasses. Tell us a little bit about tracking down the founders of Blue Blockers.
This was so much fun. I mean, basically, the world had fallen apart. I'd left Merrill Lynch and I was just so disenfranchised with Wall Street. And my buddies and I had been probably like some of the biggest buyers of Blue Blockers. We would bring them everywhere, just like pass them out. They were not expensive and we just kind of loved them. So I don't exactly recall how it happened, but I tried to find out who owned this company. And it turned out it was this guy named Joe Sugarman, who was really known to be one of the first folks to do the telemarketing. And not just telemarketing, but actually commercial marketing. Like I think he went on the boardwalk, in California, Venice Beach, and have like blue blocker commercials. And then you call like 1-800 blue blocker and the guy just tonned it.
Mm.
And the name and the brand had just kind of dissipated into history. And I found out that the company was based in Las Vegas. And it's so funny because I started to get to know all the people that worked for him because I would call them direct and I'd order like pieces of blue blockers. And it was really just something that turned from a fun idea to seeing if we could relaunch these effectively.
Mm-hmm.
And it was a blast. I mean, it was so much fun. I had him reach out to his manufacturer in China, and they made, a bunch of different styles and colors for us. And then it was just literally, we ordered as many as we could afford. They were in our apartment in boxes. We bought a bunch of commercial grade white boxes to go ship them in and just literally started shipping them from our apartment. But it was a blast. What ended up happening was I could sell these things for $40 and $50 a piece. Like I had some like white blue blockers and some gold blue blockers, and we could sell them for $50. This guy was selling them for like $12. And so we sold like our first shipment effectively, went back to him to go buy some more. And he was starting to scratch his head because he's like, why am I selling them for $15? And we kind of got in this funny dynamic where I said, I'll buy whatever you have right now retail for like $20. I paid him more than what he was even offering for. And the whole thing kind of fell apart just because I think he started to realize what we were doing. And it was really the thing that taught me how important it is to own the equity of whatever it is that you're building or working on, because I couldn't do what I wanted to do with this thing. And then it was a conversation about buying him out, and it was just kind of all over the place. It was one of my first real entrepreneurial opportunities. And at the very least, it's a good story.
It's a great story. And it looks like you were able to get some at least value from that arb trade there.
Oh, it was a great experience too. I mean, we traveled I went to his house in Chicago to go meet him. And then he invited my wife and I to his house in Hawaii. And we actually went there. I mean, it was just wild, the whole thing. So anyway.
We're coming up on the tail end here. I have two final questions. One is, can you tell us about a person who has had a profound influence on you?
I'd say my father was somebody who would just show up. He would be there when it counted. He was consistent, and all of my closest friends have aspects of what he showed me, how much he was there for my family and for his community. So he was an incredible part of my life.
Excellent. Last question. Can you tell us about a charity, cause, or other endeavor that you're passionate about?
Yeah, I just was appointed to the board of a charity that brings books to groups of people who are in really kind of like despair. So folks that have been displaced, or hospitals, or prisons. My co-founder, Bill Martinaire, has been struggling with ALS for the past 3 or 4 or 5 years now. And this was his brainchild. With the group's called Radiant Books. So we're really excited to offer some light where there oftentimes isn't.
Wonderful. Ryan, want to thank you again for taking the time. It's been a great conversation.
Thanks so much for the time. I appreciate spending some time with you.